Welcome to our CFP exam prep discussion on long-term care insurance, a critical topic that often appears in complex scenarios on the exam. Today, we're diving deep into the specifics of LTC insurance, particularly focusing on care types and tax implications. Let's start by understanding what long-term care insurance really covers. The policy typically provides coverage for three main types of care. Skilled care is provided by licensed medical professionals like registered nurses, and it's the highest level of care covered. Intermediate care involves occasional nursing and rehabilitative care, often provided by licensed practical nurses. Custodial care is the most basic level, focusing on helping with daily living activities like bathing, dressing, and eating. A common mistake test takers make is assuming LTC insurance only covers nursing home care. The reality is that modern policies are comprehensive, covering home health care, adult day care, assisted living facilities, and nursing homes. Remember this point carefully, as the exam often includes questions about care settings. When it comes to tax treatment, here's where many candidates get confused. The premiums for qualified long-term care insurance policies are potentially tax-deductible, but there's a catch. The deductibility is subject to age-based limits and must be combined with other medical expenses. These expenses need to exceed 7.5% of adjusted gross income to be deductible. For instance, if you're age 61, your maximum deductible premium in 2023 would be different from someone who's 55. The benefits received from a qualified LTC policy are generally tax-free, up to certain limits. The current tax-free limit is the greater of actual LTC expenses or the per diem limit, which is adjusted annually for inflation. This is a frequent test point that trips up many candidates. Here's a crucial concept breakdown that often appears in exam questions. For a policy to be considered tax-qualified, it must meet specific trigger requirements. The insured must be unable to perform at least 2 of 6 activities of daily living for at least 90 days, or require substantial supervision due to severe cognitive impairment. The 6 ADLs are bathing, dressing, toileting, transferring, continence, and eating. Another area where test takers frequently make mistakes is understanding elimination periods. Think of this as a deductible measured in time rather than dollars. Most policies have elimination periods of 30, 60, or 90 days. During this time, the insured must pay for their care before benefits begin. The exam might present scenarios where you need to calculate when benefits start or determine the most cost-effective elimination period. When studying this topic, pay special attention to inflation protection options. Simple inflation protection increases the daily benefit by a fixed percentage each year, while compound inflation protection applies the increase to the previous year's benefit amount. The exam often tests the mathematical differences between these two approaches. Let's wrap up with a practical example. If a policy has a $200 daily benefit with 5% compound inflation protection, after 10 years, the daily benefit would grow to approximately $326. However, with simple inflation protection, it would only reach $300. Understanding these calculations can be crucial for exam questions involving long-term care planning scenarios. Remember, when you see LTC questions on the exam, take a moment to identify whether they're asking about care types, tax implications, qualification requirements, or benefit calculations. This methodical approach will help you avoid common pitfalls and select the correct answers.